CAC, or contributory asset charge, is a charge that is assessed against the revenues of the firm for the use of all other assets other than the asset being valued. An example of a model to calculate the CAC is shown on the next slide. In the following model, each of the company's assets has been valued with the exception of the customer list. The required cash return of each asset is calculated as a percent of sales, and these returns are summed to 4.2%. The CAC is deducted from ongoing revenues to isolate the remaining income, which is attributable to the customer list. So here for ABC Company, it's a different company where we've assumed that we've looked at all of the other assets other than the customer list. So ABC Company has the following assets. It has debt-free net working capital. It has fixed assets. It has an assembled workforce. We haven't talked about that, but that's a part will ultimately be part of goodwill. It's not separately identified and valued. It has a non-competition agreement. It has software that has value, and it has a trade name. Okay, so we've valued each of those classes of assets at the fair values that are listed: $648,000, $3.5 million, $945,000, etc. We've also looked at and identified and calculated what the required after-tax return would be on each of those assets. And we have documentation and we have support for each of those calculations. So the debt-free net working capital has an after-tax return, required rate of return of 5.2%. That reflects the relatively low risk of working capital. And as you notice, as we go down the list, we increase in risk, and therefore we're going to increase in required after-tax return. So the fixed assets have a required return rate of 6.2%. The workforce has a required rate of return of 12%. The non-competition agreement, 13%. The software, 15%. In the case of the trade name, it has the required after-tax cash return as a percent of revenue is whatever royalty rate we use. We'll talk about the valuation of trade names in a minute. But the royalty rate we use netted for taxes. So the royalty rate was 3%. So the after-tax version of that is 1.95%. Okay. So we take the rate of return multiplied by the fair value gives us the required return. Okay. And the required return relative to the corresponding revenue level is the required after-tax cash return as a percentage of revenue. We add those up, and that gives us, in this case, relative to this ABC company, a total contributory asset return of 4.2%, meaning that of the total revenues of the company, okay, the required, or the total contributory asset return, the return relative to all those assets, those 6 classes of assets on the left, is 4.2%. Okay. What that does not include is the last asset, which is customer list. The customer list is a separate required return. We're going to remove the 4.2%. What's left over, but by definition, has to be attributable to the asset which we're valuing, which in this case is the customer list. Okay, documentation required for the CAC calculation. So when you are questioned on your valuation by the auditor or the valuation audit team, they can ask you for any of these documents, and you should have them. Identification of all assets that are included in the contributory asset calculation. Working capital calculations. How did you arrive at $648,000? Where does that number come from? Land, required rate of return, how calculated? Okay, so when we have $3.5 million, was that the book value of the property, plant, and equipment? Was it an appraised value for the property, plant, and equipment? If it's the appraised value, who gave you those values? The real estate appraiser, machinery equipment appraiser? Where do those numbers come from? Other intangible assets, if they exist in the company, we should be identifying them and valuing them. And then we switch to the intangible asset. Each intangible assets and a required rate of return should be explained, okay? And that goes without saying. You have to explain, we the appraisers have to explain every metric on this chart. Where do the values come from? Where do the required after-tax return rates come from? How are they calculated, okay? For that number, for the 4.2% to have integrity, all of these other variables have to have integrity. Otherwise, this is nonsense, okay? And we have to have that support in our work files. The royalty rates on trademarks, where does that documentation come from? So I said the royalty rate on the trade name was 3%. Why wasn't it 2%? Why wasn't it 5%? Where does the 3% come from? What is our support? Okay. The assembled workforce calculations, we'll talk about in a minute how to value the assembled workforce. But as I said before, assembled workforce is something we can identify and value, but it's not separable from the company. So at the end of the day, it's going to be included with goodwill. Explanation of the number of years that the contributory asset charge applied is different from the economic life of the asset, and an explanation of any CAC changes year to year, an identification of any assets that are not included in the contributory asset return, and why.